trading the bond market in the futures. Now, if you look at the futures market and you see the 10-year bonds, what you can see is that they're very, very, very steady and reliable the way they trade. It's mainly institutions that trade the bond market. And just look how slow the price action is and how steady the price action is. It's a very sort of stable, doesn't move very fast market, and it's relatively easy to read. You can quite easily see what, okay, look, trap sellers, price moving up and up and up. Okay, you've got some buyers, them getting trapped, and they becomes a point lower. And at the moment, here you got sellers trapping those buyers at the previous point of control. And you can look on the tick chart and use about 2,000 ticks. And you can see there, it's not a bad chart. You can see that how quickly and easily the market responds. So the bond market is an interesting market to trade, but you always know how to trade it. Just want to check you've got the understanding right. What I've got overlaid here is the bond market and you've got the US 10-year bond in the green line, and you've got the US 10-year yield in the candlestick chart. And what you'll notice is that they move exactly inversely to each other. So when yields go up, it's because the price of the bond is going down. When the price of the bond is going up, that means yields are going down. In other words, when the price is rising, the bond is in more demand, and the yield on that bond falls in relation to its price. They are inversely correlated. What you're doing when you're trading the futures bond market, you're trading this US 10-year bond here, this green line, that's what you're trading. Whereas what we're looking at now is the US 10-year yield. So the way to understand it, the simplest way to understand it is the direction of the yield is the direction that interest rates are expected to go. That's the rule of thumb. So if yields are going up, it's because interest rates are expected to rise. If yields are going down, it's because interest rates are expected to fall. Okay, that's the relationship. Rising yields are rising interest rates. Falling yields, falling interest rates. Now, the exact opposite is true for the price of the bond, right? And you can see that Brian got that right in the Discord channel, which is if you're expecting interest rates to fall, the price of the bond goes down. If you expect interest rates to rise, the price of the bond goes up. So what that means for the treasury market is if you are expecting rate cuts are coming, so if you think, okay, the Fed will have to cut rates. So if say there's a very weak jobs print, job openings fall to 1 million, crisis, right? Then what will happen is markets will expect the Fed to cut interest rates, and so the price T notes will just go up, right? So buy bonds. You'll buy bonds because interest rate cuts are expected to come. Now, if it's the opposite, if you're expecting interest rates to fall, right? So if you're expecting interest rates to rise, say the JOLTS comes in at 12 million, and then the NFP comes in 500,000. Oh, the labor market's fantastic, and tariffs are working, and the US has never been in a better state, right? Then it will mean that the Fed will be more likely to keep interest rates higher for longer, and so you'd sell bonds, right? So the way to understand it is just remember the yield moves into the market's expecting interest rates to go. So if the yield is going up, it's because markets are expecting interest rates to go up. If the yield's going down, it's because markets are expecting interest rates to go down. The price of the bond moves exactly inversely to the yield. So very simply, if you believe rate cuts are coming, you buy bonds. If you believe rate cuts are not coming, then you sell bonds, right? That's the relationship. So, if you get a really clear narrative, just look how steady the bond market is. So if you get something like, hang on, this is going to be an all-day move, you just notice how kind of reliably the bond market. It's not very whippy. Do you see the way it moves? It's like, there's the, if it was a Lord of the Rings character, the bond market would be the end. You know what I mean? They take a long time to make their decision, but when they move solidly, you know, it's boring. Yeah, it's boring. Yeah, exactly, Brian. It's boring but effective. And there's an old saying, isn't there? The bond market is the truth. And bond traders, they tend to be investing for sort of, 12, 18, 24 months, steady, no risk, very risk averse market. So you tend to see that kind of steady, more pronounced moves, if you know what I mean. They trade for years. Yeah, they're not as quite old as then, but the bond market is the truth, and the bond traders always looking 12, 18 months, and the ultimate. Yeah, yeah, Brian. I think that's, and also like there is the shorter bond. Just want to see if there's a 2 year note here. I'm not sure. Do they have the 2 year on the It's got the Z. Let's just see if there's a let me just check. So there's another code for if there's got the 2 year bond market. I'm just gonna have a little quick look because the 10 year is sort of a steady move, but 2 years can be more responsive. Okay, it could be Z, right? ZT. Let's have a little look at the here we go, the 2 year note. All right. So that's the 2 year. So that's the 2 year market. And if you want the 5, it's ZF. Okay. Um, Sort of bringing this up to relevance for today, if we see a very weak JOLTS job openings, okay, yeah, it's the speedboat. If you believe rate cuts are coming, you buy bonds. If you think the Fed's going to delay rate cuts, you sell bonds. That's the relationship. So it's a sort of thing. Say you got the non-farm payroll and you had a terrible miss. That could mean rate cuts are more likely to come, so you would buy bonds. It could be quite a straightforward trade.